Stop scrolling. I want you to think about three things. Why is your mortgage rate still painfully high, even though the Fed has been cutting rates? Why did the stock market randomly crash by 6% in a single week last year with almost no warning? And why does it feel like no matter what Washington does, no matter how many press conferences Jerome Powell holds, money still feels tight? Now, here's what every financial news channel told you. They blamed inflation, they blamed China, they blamed AI valuations, they blamed the guy in the Oval Office. They were all wrong. The real answer is hiding in a place nobody is looking. It's not in Washington, it's not in Beijing, it's in Tokyo. And it involves the single most boring financial instrument on earth, Japanese government bonds. I know, sounds like a cure for insomnia. But here's what I promise you. By the time this video ends, you're going to understand why a policy decision made in Japan has more power over your mortgage rate, your retirement account, and the cost of every loan in America than almost anything the Federal Reserve does. And once you see it, you genuinely cannot unsee it. Let's go.
Japan's lost decades. To understand what's happening right now, we have to rewind to Japan in the late 1980s. Japan in the 1980s was on absolute fire. The economy was the envy of the world. Real estate was exploding. The Nikkei stock index was going parabolic. Japanese companies were buying American assets left and right. Golf courses, skyscrapers, movie studios. There was a famous moment where a Japanese company bought Rockefeller Center in New York. Americans genuinely panicked. People thought Japan was about to take over the global economy. At the peak of the bubble, the land value of the Imperial Palace in Tokyo was estimated to be worth more than the entire state of California. One palace, worth more than California. But like all bubbles, it ended violently. In the early 1990s,
Japan becomes the world's ATM. Imagine you manage a Japanese pension fund. You're responsible for the retirement savings of millions of people. Your portfolio is worth hundreds of billions of dollars. And your domestic government bonds, the safest asset in your home market, are paying you 0%. What do? You can't accept zero returns. You have retirees depending on you. You have obligations to meet. So you do the only logical thing. You go shopping overseas. And that's exactly what Japan did. Pension funds, life insurers, regional banks, the massive government pension investment fund, the single largest pension fund on the entire planet, they all had the same problem. Domestic yields were worthless, so they all looked abroad. And when you're the world's third largest economy, with decades of accumulated savings, you have an enormous amount of capital to deploy. Japan quietly became the world's largest net creditor nation, the world's ATM. They became the largest foreign holder of U.S. Treasury bonds, at one point owning over $1 trillion worth. One of the largest buyers of U.S. mortgage-backed securities, directly influencing the mortgage rate of every American homebuyer. And a massive investor in European bonds, global equities, and emerging market assets. All of this capital flowing out of Japan kept long-term interest rates lower than they otherwise would have been. It provided a steady, reliable demand for U.S. debt, and it fueled a global liquidity.
The yen carry trade? Let me introduce you to Bob. Bob is smart. Bob understands finance. And Bob has figured out what looks like a nearly perfect trade. Here's what Bob does. Bob goes to the Japanese financial market and borrows the equivalent of $10 million in yen at an interest rate of basically 0.1% per year. His borrowing cost is almost nothing. He converts those yen into US dollars. Then he buys US Treasury bonds yielding 4% per year. Do the math. Bob earns 4%. Bob pays 0.1%. Even after hedging costs and currency fees, Bob is pocketing a spread of 2% to 3.5% per year. On $10 million, that's $200,000 to $350,000 in annual profit for essentially borrowing cheap in one place and lending expensive in another. Now, multiply Bob by thousands of hedge funds, banks, pension funds, and trading desks, all doing the exact same trade with billions of dollars. At its estimated peak, the yen carry trade was worth somewhere between $3 and $4 trillion. The global financial system was quietly running on cheap Japanese money. And when your cost of capital is essentially zero, your risk appetite expands dramatically. Carry trade investors didn't just buy treasuries, they bought U.S. tech stocks, high-yield corporate bonds, real estate in major global cities, emerging market equities, commodities. Basically, if it had a pulse and a return above zero, they bought it. The yen carry trade wasn't just providing liquidity to the treasury market, it was providing liquidity to global risk assets. It was one of the hidden engines driving asset prices higher around the entire world. And the whole thing, every single trillion of it, rested on one assumption: that Japanese interest rates would stay near zero.
The assumption breaks. For a long time, that assumption held. But by 2022 and 2023, something started shifting. Global inflation forced central banks everywhere to raise rates aggressively. The Federal Reserve hiked at the fastest pace in 40 years. Europe hiked. England hiked. Almost everyone hiked. Japan held out. They kept rates pinned at zero, which made the carry trade even more attractive in the short term, because the interest rate gap between Japan and everywhere else was getting wider. But it was also destroying the Japanese yen. At one point in 2022, the yen hit its weakest level against the dollar in over 30 years. And a weak yen meant Japan's import costs for energy, for food, were surging. Inflation was creeping into a country that hadn't seen meaningful inflation in decades. The Bank of Japan was trapped. Keep rates low and watch the yen collapse, start raising rates, and risk blowing up the carry trade. In 2024, they made their choice. The Bank of Japan ended yield curve control and then raised interest rates for the first time in 17 years, then raised them again. The reaction was immediate. The S&P 500 dropped 6% in days. Japan's Nikkei 225 plunged over 12% in a single session, its worst single day since 1987. Volatility exploded.